It does feel like we've been through rolling recessions, housing and autos, two negative GDP quarters in the first half of last year. And so it feels like this is one heck of an extended turning point in the economy.
Hey guys, welcome back to Library of Wealth. ARK Invest CEO Cathie Wood gives us her market outlook for the next few months and discusses the lack of trust currently in many financial institutions. Wood believes that investors may now be resorting to keeping their money outside of the system and warns that we've never seen market volatility like this before. She notes that interest rates have increased significantly in 1 year, which is a major shock to the system. However, Wood believes that the Federal Reserve is not acknowledging the stress on the banking system. She says the Fed's plan to raise interest rates too rapidly is already a huge mistake, as it will risk tipping the economy into an unnecessary and deep recession. Let's get right into the latest interview with Cathie Wood as she gives her market prediction for the coming months and what we can expect heading into the first half of the year. If you enjoy the content we do here, don't forget to hit the like button and subscribe to the channel. Let's get right into the video.
University of Michigan Consumer Sentiment Index relapsed. So we're back into deep COVID and 08-09 territory in terms of the sentiment index. And it makes sense. It's that regional bank crisis. It's consumers saying, wait a minute, what's going on? Are we safe? Are we safe in our banks? That's a big one, right? And it was a big drop and a big surprise. The other thing in that report was consumers saying, I think inflation's going up. And I think one of the reasons for that was gasoline prices did go up. And the consumer is railing against price increases. And that's why we think a lot of companies are going to start cutting prices. Home Depot said it was going to start cutting prices. We have a debt deal now that President Biden is going to sign. We're not going to have to worry about this until early 2025. They're taking this off the table for election year campaign season, and it makes sense. It's astonishing how fearful the market was of default, though. Credit default swaps on U.S. sovereign debt rose at its peak to 325. Now, this is the price of an insurance policy against default. So it went up to 325, and within the last few days, it's down to 10. So the fear out there was extreme, and the market is enjoying, the stock market, some of a relief rally associated with that fear going away. M2 officially now dropped 4.6% on a year-over-year basis in April. And we think that it will continue to accelerate to the downside. We think it'll be down 5% or more in May. I'll say it again. It is shocking to me that the Fed never talks about money supply. I was early in my career when Fed Chairman Volcker was focused on inflation, and all we talked about was money supply. So quite a big difference. So the question now is the Fed going to pause? And we keep getting different stories from different Fed governors and presidents and so forth. If you look at the two variables that the Fed has focused us on, employment, and you look at the headline numbers, including today's, we'll get into that in a moment, you'd say, no way are they going to pause. They're going to keep lifting rates. Employment is too strong. If you look at the details inside today's report, and maybe I will go through that now, you'll see that they may be having second thoughts. While the headline number, non-farm payroll, was up 339,000, I believe, much stronger than the 250 to 280,000 expected. Another number, which is actually a leading indicator of employment, but it's buried deeply into the report, is called household employment. So payroll employment is a survey of corporations. Household employment is a survey of households. And that number was down 310,000, which is pretty shocking to see that kind of a divergence. The Fed is going to have some interesting statistics, we think, in the next couple of months. And it's mostly because of what happened last year as opposed to this year. It looks like the CPI is settling into the 0.1 to 0.3 range. The comparison from last year for May was 0.9, and for June it was 1.2. That's month to month. So we're going to be dropping off some big numbers here. And we wouldn't be surprised to see the number in July, reported in July for June, to be around 3%. And to give you a sense of that, a year ago, June, the number on a year-over-year basis was 9. So 9 to 3 within 1 year's time. And we think the evidence is brewing that that number is going to continue down and probably will go negative. And when the Fed recognizes that that is the case, as we believe they will, there are all kinds of leading indicators, which I'll share with you in a minute, then it is going to change its tune. And by that time, we're probably going to see more increases in the unemployment rate. So today we got an increase from 3.4% to 3.7%. And the reason was that household measure fell 310,000, while the labor force, so the people out there looking for work, actually increased by nearly 150,000 people. So that's a 0.3 of an increase in the unemployment rate. It does feel like we've been through rolling recessions, housing and autos, 2 negative GDP quarters in the first half of last year. And so it feels like this is one heck of an extended turning point in the economy.
She's identified 2 mistaken assumptions made by banks during the last 3 years, namely that they would be fighting a depression and that interest rates would not go up, which led them to invest in long-term securities. However, interest rates have increased 20-fold in less than a year, which has sent a massive shock through the system. According to Wood, the Federal Reserve's quantitative tightening, where it is selling assets, has resulted in a decrease in the Treasury bond yield from 4.3% to 3.6% since October. She highlights that bondholders are the most focused on inflation, and managing long-duration assets is challenging when there is a fear of inflation and rising interest rates. On the other hand, she suggests that despite the Fed increasing the supply of bonds in the open market, the expected real yield has actually gone down. Wood believes that this is due to a flight to quality, where people are worried about the security of their assets and deposits in banks, leading to panic buying of government securities, pushing the price of bonds up and the yield curve down. What do you think about Cathie Wood's latest interview? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.